Hi, and welcome back to part 7 of the narrated PowerPoints on the balance of payments. Okay, so the last section that we need to cover in the booklet, starting with essentially the bits that you can see in red. So we covered the components of the balance of payments and the current account and the capital and financial accounts, and explained what those are in previous narrated PowerPoints. So we're going to look at B, C and D, which are all part of the 4.1.7 specification. The first one is the cause of deficits and surpluses on the current account, what causes them. Then we're also going to need to look at measures that might reduce a country's imbalance on the current account, and also what the significance of global trade balances are. Okay, so you'll see as we go through this is much more a case of sort of summing up some of the issues that are facing economies with interesting balance and payments issues, and also we try and sort of put together some examples of the typical way in which you might start to answer questions of this nature, and the sort of evaluative approach in terms of, well, if one thing happens, what happens to something else. So that's the sort of plan for this particular presentation. Okay, so without further ado, we'll crack straight on. Okay, so first things first, let's move on and take a look at a bit of a summary, bit of a revision, if you like, in terms of what the balance of payments is used for, what is actually recorded on the balance of payments first and foremost. Okay, so we looked at this previously. Basically, the balance of payments is essentially looking at both the current account and the financial account, and all the bits, that the constituent parts that make up those things, and it's all about attempting to understand how the balance of payments can be affected by different changes in the level of trading goods and the level of trading services, but also the financial transactions that are used to put in place the affordability of imports and exports, etc. So, as we said before, the financial account, any financial transactions that might take place are designed to try to finance the imports and exports that are going on within your country. Okay, or the difference between the two. So, first things first, then, a bit of a task for you. You'll see in your booklet that you've got a task which actually explains that there are a range of different things, different examples, transactions that might happen on the balance of payments, and we want you to have a look and think about whether this is going to be a credit or a debit, and also whether you would record this on the current account or the financial account. Okay, so you might need to look back at your notes to see what different types of transactions go where, but fundamentally we'd like you to answer those 8 examples, starting with a British consumer buying a car manufactured abroad and running through to the question number 8, which is a foreign investor depositing money in a UK bank account. So if we just flick through those, you can see there are 8 examples, and I'd like you to give that some thought, and as I've mentioned previously, consider whether you think it's either a credit or a debit. A credit, it means it's going into the current account or the financial account, and it's going into our a credit balance, so it's money coming into our country essentially. Okay, and debit would be money going out of our country. Okay, or our balance of payments in this case. So I'm going to give you some time to give that some thought. Have a go at answering those questions, and then we'll come back and also essentially stop this PowerPoint. Have a go at answering the questions, and then we'll crack on and look at the answers. Okay, so in terms of the answers then, let's take a look at the tasks that were set. Okay, so essentially, if we take the first one, a British consumer buying a car manufactured abroad. Well, clearly, if it's been manufactured abroad, we are importing it. So that's going to be a debit from our current account, because essentially we have bought a good, or in this case, we bought a good with our sterling, and essentially in order to do that we've had to swap our sterling into the currency of the country where the car was manufactured, and in that instance it's a debit transaction on the current account. Let's take a look at the next one then. A foreign consumer buys a car manufactured in the UK. Well, that's pretty much the opposite of what we just looked at there, isn't it? Okay, so that would be a credit, because essentially we as a country are exporting that car to the foreign consumer, and that would be a credit in our current account. That would be money coming into the country, wouldn't it, essentially? So trade coming into the country. A British tourist travels on a foreign airline. Well, that clearly would be a debit, because if we're using a foreign airline, we're actually having to buy a ticket for that foreign airline, and that would be a debit from our current account. Essentially, it's a service, isn't it, of sorts. It's not a product as such. It's a service we're using the foreign airline. Okay? So next one, in terms of the next one, a foreign tourist spends money on a holiday in the UK. Again, it's sort of an opposite, isn't it? Okay, that would be a credit, because the foreign tourist would have had to have taken some of their currency, converted it into pounds, and that would be a credit in our country, because they're spending money in our country, and that would be on the current account. Next one, a British investor buys a share in a foreign company. Okay, so if we're buying a share in a foreign company, we're clearly investing outside of our economy, and that would essentially be money going out of our economy, and it would be a debit, and that would be from the financial account, because obviously that's a financial transaction rather than goods or services being swapped for the transaction. The next one, a British company pays a dividend to an investor in a foreign country. In that instance, that would be again a debit, but in this instance, because it's the dividend is being paid, it's actually a debit from our current account rather than the financial account, because essentially the investor has made the investment, and the British company is essentially having to pay that investor a dividend, a share of its profit. And that would come out of our current account as opposed to the financial account. Okay, last two then. A German company based in the UK sends profits back to Germany. Well, in that instance, obviously they've made the profits in our country, but clearly if we are sending that, or if the German company is sending that back to Germany, that would be a debit from the financial account, because it's a financial transaction. Okay. And finally, last but not least, the foreign investor depositing money in a UK bank account. Well, in that case, if they were choosing to do that, probably they would be doing that because our interest rates would be relatively higher than another country, or the country that the foreign investor is investing in at the moment. And that would be a credit, so that would be money coming into our financial account. Okay, so just a few examples just to try and get your head around that as a principle. Okay, so let's take a look at the next thing then. We've talked about the components of the balance of payments, and this again is just a little bit more of a revisionary thing, just to make sure that you've got your head completely around that. And in this instance, we're talking about, let me just move myself slightly so you can see all of the text. So in this instance, again, the three elements of the balance of payments, components of the balance of payments. Number one is the current account. And we talked about that in a little bit of detail. The transactions of exports and imports, including investment income and transfers with the rest of the world. Then we've got the capital account, which is to do with recording transfers of fixed assets. And then we've got this balance where if we can't finance the level of imports based on the amount of exports that we've achieved, then obviously we're going to need to finance that by borrowing money from somewhere else in order to make that work. Okay, so that's again just a little bit more revision. I know we've gone through this several times, but it's just to make sure that you are clear as far as that is concerned. Okay, so let's take a look then at the next thing then. We're going to start to look at global trade imbalances, okay? Now this essentially, if you're going to define it, is basically where you've got a persistent balance of payments, current account surplus, or a deficit, okay? And so effectively, if you like, one person's surplus is going to be somebody else's, or one country's surplus is going to be somebody else's deficit, isn't it? So this imbalance, this global imbalance between certain businesses, certain countries, certain economies, actually always running either a deficit or a surplus. Is that okay for that to happen? Well, you could argue that provided people are willing to carry on, then yes, it probably is okay. However, if we take a look at this video that you can see now, what I'll do is again, when I send you this information, I'll also send you the original PowerPoint that you can then view in full screen, and the links here. This trade imbalance video should work, and you can have a look at that. It's only a couple of minutes long, but it's quite a nice summary. And listen to the way that Martin Wolf explains this process. It's very, very good in terms of, well, if this thing happens, this happens as a result. So sort of good chains of reasoning, and also some nice evaluation in there. It's only a couple of minutes long. I'd like you to take a look at that, make a few notes on it, and then obviously we can come back and talk about that further later. Okay, so I'm going to, if you essentially stop the PowerPoint, stop the narrated PowerPoint here, go and have a look at the actual PowerPoint that I've put onto Google Classroom, and you should be able to then go and view the link to the FT video. Okay, so that's quite a nice summary. Hopefully, you've had a look at on global imbalances and what some of the issues are. And here we've got a couple of charts, yet more charts showing a number of different things. Okay, now what I'd like you to do in the first instance is to take a look at, in this case, we've got current account balances and we've got percentages. We've got Spain, India, United States, Brazil, United Kingdom, Ethiopia, and Kenya. And you can see each line has slightly different colour included, and it's running from 1999 through to 2019. You can see that if we actually take a line around about 2012 onwards, okay, you can see that they are dotted lines. So what has happened is there's been an extrapolation. That hasn't the actual figures, but at the time that this graph was drawn up, they extrapolated, they took the trends and actually looked to see where they thought the trade imbalance, or the trade balance, or current account balance was going to go. Okay, now what we'd like you to do is have a look at that, see if you can spot any particular trend, any change, and in this instance, obviously, where we're talking about a current account balance, we've got 0%. So obviously in that instance, that means that we have the account, or the balance of payments, in balance. Okay, so at 0%, so all of the transactions that are happening are equal. However, in this instance, you can see most of these countries are in significant deficit positions, and it's just worth taking a look. So if we take a look at this one in particular, so if we just double check which one, this is Ethiopia, you can see that they have been around about 2000, they were just about at equality, if you like, at the point where they'd actually the balance of payments was just about in balance, but you can see there's been significant drops, and there is normally going to be a very good reason for that. But if we trace that, and you can comment on the fact that during the period of pretty much since 2000, Ethiopia has been in a significant current account deficit, okay, and there's probably very good reasons for that. So for instance, maybe they're importing a lot of goods and services, maybe they're reliant on just one or two different goods or services that maybe, commodities that maybe haven't been in quite such great demand. Again, normally there will be a reason for it. Okay, so you can see, there are some significant countries that are, well-developed countries that are running significant deficits. So we've got the UK, we've got the US, and we've got other situations where these things are changing. Okay, so take a look at that, obviously make some comments on that, and then let's take a look at the next chart, which actually starts to look not so much at current account deficits, but actually in this instance current account surplus. Now remember, when we're trying to calculate a current account balance, whether it's a surplus or whether it's a deficit, normally speaking, it's the majority of that figure is going to be made up of the difference between imports and exports. Okay, so if you're exporting more than you're importing, you as a country will be running a current account surplus. But in this instance, where we're looking at the charts here, most of these countries are actually importing more than they're exporting overall, and as a result of that, they have current account deficit. So whereas again, any country that has a line that is below 0% is running essentially a current account deficit. Okay. Looking at the next example then, and in this instance we've got further graphs which actually talk more specifically about those countries that are running current account surpluses. Okay, now you can see we've got Singapore, Germany, Norway, Russia, China and Japan. Now again, there are going to be reasons why they are in surplus as opposed to deficit, and that could range from them being more internationally competitive. So if we take Germany as an example, generally speaking, they are considered to be quite an internationally competitive country. They've got very efficient industries, and also they're producing goods and services that other parts of the world are willing to buy. Okay, so but Singapore, as you can see, have got significant current account surpluses. Norway also have had a significant amount of current account surpluses, and again there are reasons for that. Norway, as I'm sure some of you know, and we've certainly talked about before, have a significant resources that have been sort of handed to them on a plate, if you like, because they happen to have a very long coastline along the North Sea, and they've benefited significantly from North Sea oil. So again, normally speaking, it will be a good reason for current account surpluses. China, as we know, have significant current account surpluses because they export so much of their goods, their manufactured goods around the world. They also, as we know, tend to use devaluation as a policy tool to reduce the price of the value of their currency, in order that their manufactured goods appear to be cheaper than lots of other parts of the world. Okay, and that's something that we'll look at in a bit more detail. Okay, so normally speaking, there will be a good reason why one country will either have a current account surplus or a current account deficit. Okay, and essentially, if one country has a particularly high surplus, then at some stage, other countries are going to be having to suffer in terms of running current account deficits. Okay, and let's say, if one person is winning or one country is winning, then another country is probably suffering in some shape or form. Okay, so quite nice, and it would be nice for you to actually have some facts and figures at your fingertips as to why some of these countries are tending to run current account surpluses or current account deficits, and be able to compare and contrast one with another. Okay, so that would be a useful thing for you to do as a result of what we're talking about here. Okay, so let's have a look at some of the causes of trade imbalances then. So we've looked at you've got a couple of charts in your booklet that you can highlight and annotate, and also maybe do a little bit of research around that to really sort of complete your knowledge on this. Okay, now there are a number of reasons for trade imbalances. Okay, and we've listed a few here, and we're going to look at some of the reasons why those things might impact on the current account of different countries. Okay, now obviously the first thing we're looking at is something called the savings ratio. Okay, so differences in the savings ratio will cause trade imbalances to happen. Let's have a look and see what a savings ratio is. Okay, so basically that's essentially the proportion of disposable income that's not spent on consumption. Okay, so clearly if we have a very high savings ratio, that means that we might have plenty of disposable income within our economy, but individuals choose not to spend that on consumption. So one could argue that must mean that we've got a high marginal propensity to save. MPS must be at a high level. Okay, so what would be the impact on the current account of the UK or the US of having a low savings ratio? Well, effectively, if we have a low savings ratio, then that's going to mean that we're going to have high consumption. Okay, because and that will lead to greater levels of import and so to a current account deficit. So if we've got high levels of consumption, we talked about this before, haven't we? As far as aggregate demand is concerned, if we've got high levels of aggregate demand, the general trend is for more countries to import more goods and services because they have high levels of demand for products and services. And as a result of that, if that happens, high levels of import means you're going to have a current account deficit. Okay, more imports and less exports mean we're going to have a current account deficit. Okay, let's have a look at what the impact of the current account of China, Japan, and Germany and having high savings ratios might be then. Okay, well, in this instance, obviously, if you've got a higher level of savings ratio, you've got a higher proportion of people choosing to save rather than to spend. That's going to lead to lower levels of imports, and so could, in some cases, mean that you're going to have a current account surplus. Remember, the current account surplus fundamentally is the difference between imports and exports. And in this instance, if we've got less imports relative to exports, that's going to mean we're going to have an improvement in the current account position, and in some cases, maybe even a current account surplus, which clearly would be a good thing from an economy's perspective. Okay, so that's the first thing. So the savings ratio, the proportion of disposable income that people are spending on consumption, will have an impact on trade imbalances for the reasons that we just described. Okay, the second thing that we talked about, and obviously need to talk about in a bit more detail, is this principle of exchange rates. Okay, now clearly, if our exchange rates are being manipulated or changed, or in some cases, if we take China as the example, where they're fixing the value of their currency and trying to manipulate that, that can clearly have an impact on all of the things that we've just talked about, can't they? Okay, so exchange rates clearly can have a fundamental impact. Okay, so in this instance, if we take the scenario as is described there, what is the impact on the current account for China and the US of China fixing the value of their currency at a low rate against the US dollar? Well, clearly in that case, if that is the case, then China is going to have price competitive exports in comparison to, particularly in USA markets, and that's going to lead to a current account surplus with the USA. Now, effectively, what that means is that if we're looking at the trade, the relative trade between the two countries, if you've got price competitive exports within a particular market, that's going to mean that you as a country are going to end up exporting more than you are importing from that particular country. So the trade, if you like, the trade balance between two countries will be fundamentally affected by that. Okay, if we think about this then, and what the implications of that are, if the US has products that are less price competitive in its home markets and in China, that's going to mean that effectively we're going to have the USA is going to have a current account deficit with China. Okay, so if you like, they're going to be hit. It's a double whammy, really, isn't it? In that imports are going to be higher because they're cheaper, and exports are going to be lower because, again, that's obviously going to mean that the US is less price competitive. Okay, so There's one example. Let's have a look at the next question then. How has Germany benefited from being in the Eurozone? Okay, and again, this is a question that you could have a go at yourself. But in terms of the response that you can have a go at in your booklet, have a go at that question, and we'll come back and then look at what the answer would be. Okay. Okay, so if we take this example then, so in this instance, if we're talking about the benefits of being in the Eurozone, the benefits of being within a trading bloc that actually you have a common currency, means that actually you've got some real benefits for that. So Germany, clearly, if it's exporting its production to other Eurozone countries like Spain or Portugal or the UK or any other individual, or not so much the UK, it's not a bad example, sorry, but because we're not in the Eurozone, yes, we're sort of part of the European community, etc. But where Spain and Portugal and Germany actually are trading in the same currency, obviously they have no currency fluctuations. They all have the euro as a currency, and there's going to be no currency fluctuation or appreciation in the exchange rate. It's going to be consistently, the trade is not going to change based on the value of the currency. Okay, so hopefully that all makes a reasonable amount of sense so far. If we then move on and take a look at the next example then, okay, so to some degree we're looking at the same sort of thing again, but again, we sort of touched on this previously where we were looking at effectively the current account balances between countries, okay. Now in this instance, okay, that is looking at the difference between the current account balance based on the trade between China and the US. Okay, so here we have a comparison over 2004 through to 2014, and during that time, the Chinese balance of payments, the current account balance of payments, has been in surplus. Okay, so you can see the green line shown here, and we've got the Chinese globe, so to speak. And you can see that in this instance, where we're talking about percentage of GDP, we've got a 5% surplus up to nearly 10% surplus, falling slightly. And as you can see, relative and what, like we've described, really, if you think about it, if the relative figure of surplus is dropping, if we're talking about one country in comparison to another, well, that would then indicate that to some degree there must be an improvement in the level of deficit in the other country. And you can see here that effectively where there has been a slight improvement in terms of from around about 2008, 2009 maybe, well, where the surplus for the Chinese economy has sort of fallen a wee bit, then you can see that the US has actually improved slightly. Okay, so oops, sorry, back one. So in this instance, you can see the current account surplus has diminished, has fallen slightly, peaking at nearly 10% in 2007. But the surplus has still averaged at least 2% of GDP in the years from 2012 through to 2014. Okay, so this is only countries. There's no other countries involved. This is just trade between the two countries. Okay, now looking at what's caused that, then, okay, what do we think has caused this trade imbalance, and what are the economic effects of this trade imbalance? Well, I think the main thing is going to be either the fact that goods and services that are being supplied by the country involved are more attractive, or alternatively, this is down to, in this case, probably the use of China in terms of the way in which they're manipulating the value of their currency, okay, in order to try and stimulate more goods being bought and manufactured goods being bought. China has actually spent a lot of time and money keeping the value of its currency low in relation to it's some of its main trading partners, one being the US, and as a result of that keeps their current account balance of payments in credit, if you like, i.e. in surplus, and to a significant level when you look at it as a percentage of GDP. Okay, so some of the things that cause deficits and surpluses, I think we'll move on, take a quick look at this one, and then we will stop and have a bit of a break. Okay, so in terms of the causes, then, okay, there are some short and medium term factors behind a current account deficit. Okay, normally speaking, they are going to be for a number of reasons as described here. Okay, so one could be one thing that could cause a current account deficit is a rapid debt fuel growth caused by rapidly rising consumption and or government spending increasing aggregate demand and then increasing the level of imports. Okay, so that can sometimes be created by trying to stimulate extra demand in it. So if we're talking about demand side policies trying to encourage aggregate demand, that more often than not is going to cause, particularly if it's a rapid change, okay, a rapid significant change, is going to cause a current account deficit in the short to medium term. Okay, if you've got a high marginal propensity to import, okay, so if we have a high level of inclination to import, then that clearly is going to cause significant changes in the current account deficit. And if we've got high levels of income, generally speaking, if we've got high levels of income and high levels of consumption, then that is going to mean that we're going to have significant demand for imports. And obviously, as the majority of the current account is going to be made up of the difference between imports and exports, anything that is going to then fuel imports is going to cause current account deficit in the short term. Okay, there might be some capacity constraints within the domestic economy. Okay, now clearly, if we can only produce certain goods and services, and we can't satisfy the overall capacity, if there's still demand for those goods and services, then in some instances we're going to find that people will try and find other sources of supply, and that clearly can then mean that more imports are going to be made in the short term, okay, to satisfy demand. Okay. Other things that can cause it, a relatively high value of a country's currency. Okay, remember, if we got a high value, high exchange rate, we think about spiced, strong pound, imports cheaper, exports dearer. Well, in that instance, clearly, if we've got a high level of currency value, that's going to mean that probably we're going to get more imports because they're cheaper, and exports are going to be less prevalent because they are relatively dearer. So that's another reason why in some instances we might find in the short to medium term that could actually create a current account deficit or a worse position. Okay, external shocks can clearly have a fairly fundamental impact, particularly if we're reliant on, let's say, a commodity like oil, for instance. So if we have a significant fall in the oil price for an oil exporter, that clearly is going to cause a major issue. If we're quite heavily reliant on that as a source of income for our country, then if that price falls, then that clearly can then put the balance of the current account into a deficit position. Okay. If we've got high levels of inflation relative to other countries, that again might well become a bit of an issue, because again, if the prices are rising higher in our country than they are in other parts of the world, or the price of goods and services are rising higher, then that is going to mean that more people will be more likely to buy from other sources and rather than ourselves. So we're going to become on a price level less competitive, and that clearly could cause again current account deficits to happen. And finally, the last one, and obviously each one of these you can actually explain in a little bit more detail and go and do some research on that. But certainly if we have a recession in one or more of our export markets, our major export markets, if there's less demand for in those markets, if we're in recession, if we've got significant levels of negative growth over a period of time, then clearly in that instance that's going to mean that our export markets are going to be less likely to spend money on our goods and services, and as a result of that, that can in the short to medium term cause an issue as far as the current account deficit is concerned. Okay, so I'm going to stop there, I think, and let you just sort of inwardly digest that. And thank you for listening. We've got to the point where we're pretty much halfway through this last set of notes, and we'll move on and take a look at part 8 after we've finished this one. Okay, so thank you for listening again. Any questions, please let me know either via Google Classroom or via email, and I will do my best to answer them. Okay, thank you very much.